You are watching Market Watch, the brief overview of the key events from the world of finance. Markets are experiencing significant instability on the eve of the U.S. elections. One of the key indicators of this turbulence has been the volatility in the bond market, as well as the rise in gold prices, which indicates that some investors are switching to more conservative strategies. Gold has reached record highs, while positive economic data from the United States and a focus on fiscal policy have pushed 10-year Treasury bond yields to a peak over the past 3 months. This reflects a change in investor sentiment, which is losing confidence in the prospects for interest rate cuts by the Federal Reserve amid strong labor market indicators. According to Goldman Sachs experts, a strong U.S. economy and a soft monetary policy in Europe will further expand the spread between U.S. Treasury bonds and German bonds, and the target level may reach 205 basis points. On the eve of the elections, which will be held on November 5th, investors are beginning to take more cautious positions, waiting for new data on the state of the economy, including the U.S. employment report, which will be released on November 1st. Corporate reporting also plays an important role, as many companies disclose information about current economic conditions. Meanwhile, on Monday, representatives of the U.S. Federal Reserve expressed support for further interest rate cuts, but their opinions differed on the pace and depth of these cuts. 3 of them noted the resilience of the economy and uncertain prospects, calling for gradual and cautious rate cuts, while San Francisco Fed President Mary Daly said that current monetary policy is too tight, and even with a strong economy, provided inflation continues to decline, the Fed should continue to cut rates. These statements serve as a preliminary signal before the closed-door policy discussions that will take place at the Fed meeting on November 6th to 7th. Last month, the Fed unexpectedly cut the rate by 0.5% for the first time in 4 years, given the weakening of inflation and the labor market. Many representatives believe that further reductions will be necessary, but strong retail sales data and employment growth in September may slow the pace of rate cuts, or lead to a pause at one of the upcoming meetings. That's all I have. Follow the news carefully and be prepared for all the surprises of the market.